Alimony doesn't need to stand between you and a new home you love. Today, I'm going to share a little mathematical sleight of hand that can dramatically increase the amount you can qualify to buy when purchasing a new home while paying alimony. And do stick around to the end because I have a little bonus tip I'm going to share that can have an additional bigger impact. So lenders calculate the amount you can qualify to borrow on a new mortgage using a debt to income ratio, which is simply your monthly debt divided by your monthly income. Adding alimony to your debt can make a mess of your debt to income ratio. Happily, there is another option. Now, this video is part of a playlist, which is linked below. I want to help you get through the real estate and mortgage related aspects of your divorce while protecting your credit and preserving your homeownership eligibility. So like and subscribe so you won't miss any new posts, and it'll give the videos a little boost in the algorithm so others can benefit from this important information. So again, adding alimony to your debt can have a huge impact on your debt to income ratio and significantly reduce the amount you can qualify to spend on a new home. At a 6% interest rate, just $100 of alimony will reduce your maximum loan amount by $16,600, which scales. So $1,000 of alimony lowers your home buying budget by $166,000. Happily, there is a workaround. This isn't going to entirely eliminate the impact of alimony on your house hunt, but it might make the difference between compromising on a home you're not crazy about or buying a home you really love. The best way to understand the impact is to walk through an example. So there's a little math ahead, bear with me. I'm going to use specific numbers, but these principles do apply universally. So no matter what your income, your debts, your alimony are, this trick will always increase the amount you can qualify to borrow and spend. So for our example, let's say you make $10,000 a month, that the mortgage you want requires a 45% debt to income ratio. And I'm going to assume you have $600 a month of consumer debt. That would be credit cards, student loans, car payments, and so on. And that property taxes and insurance for the home you're buying costs $600 a month. I'll use a 6% interest rate on a 30-year loan in my figuring, but this is just for illustration. Interest rates change all the time. So let's look at how things look before alimony comes into play. If you have $10,000 of income times a 45% debt to income ratio, you'll have a maximum of $4,500 to spend on all of your monthly payments. We need to subtract $1,200 for those other debts, taxes, and insurance. That leaves us with $3,300 for your loan payment. At a 6% rate, you could borrow $550,000. Now, what happens if we add $1,000 of alimony to the mix? That $1,000 of alimony comes straight out of your maximum payment. Instead of a $3,300 monthly payment, now you only qualify for $2,300, which reduces the amount you can borrow to $384,000, a $166,000 reduction to your budget. And we talked about that before. So how do we get back some of this difference? The answer is by deducting your alimony from your income rather than adding it to your debt. It's a nifty, elegant bit of mathematical sleight of hand. $10,000 of income less $1,000 alimony leaves us with $9,000 times a 45% debt to income ratio gives us $4,050 less that $1,200 of consumer debt, taxes, and insurance, and we're left with $2,850 for your mortgage payment now. That bumps the amount you can borrow up to $475,000. Instead of $166,000 impact on the amount you can borrow, we shrunk the difference to just $75,000, which is a $91,000 improvement. Now, your mileage is going to vary based on your income, your debts, your support payments, the debt to income ratio permitted by your loan, and the interest rate you lock. But again, no matter what the specific numbers are, netting alimony from your income will boost the amount you can borrow. Not every loan program offers this option, by the way, and not every lender knows how to work with it, but conventional FHA and some jumbo loans permit this flexibility. And I did promise you a bonus tip, and here it is. If your alimony or support payments step down over time, your lender may be able to qualify you based on the lowest amount you'll be required to pay during the 10 months after closing. So let's say in the example we used above, your payment steps down from $1,000 a month to $500 in 6 months after closing. You may have another $500 per month added to your income, which would boost the amount you could borrow and spend by $37,000. So please check out the rest of the playlist, link below. And again, if you found any value in this, like and subscribe so you don't miss additional content. You can help others find it. And remember, I'm always here if you have questions. There is a link in the description where you can schedule a call. I'm happy to be a resource, and I appreciate your time. Thanks for watching.